Welcome, everyone, and thank you for joining us this morning. Before we begin with the presentation, I have a few housekeeping items I wanted to cover. For those of you who don't know me, I'm Jerry Murphy, and I'm the partner in charge of our manufacturing and distribution vertical at Sikich. For those of you unfamiliar with our firm, we're a global company specializing in professional services and one of the largest CPA firms in the United States. Again, welcome to our 24 economic update for manufacturers and distributors. Our special guest, Michael Weidokal, will be joining us this morning. We're thrilled to have him back for the economic update for a third time. Very popular. Thank you for coming back, Michael. We appreciate it. I want to let everyone know that the presentation slides are available for download in the handouts tab of the control panel of our meeting this morning. If you have any questions for Michael during today's session, please submit them into the question tab of the control panel, and I'll try to submit those to Michael during our Q&A. We are recording the presentation, and the PowerPoint slides and that presentation will be distributed in the coming days. For those of you wishing to receive CPE credit, you should be able to use the QR code or the web address that's listed in the slide that you're currently seeing. You can log into Conferences.io and it will ask you for your name and your company. You log in and I'll give you three numbers throughout the presentation that you can submit and it will provide a CPE certificate to you in the next week or two that we'll send that out to you for those of you who need CPE. If you have any challenges with Conferences.io, there is a guide in the handout section of the control panel. So I'm going to ask Michael, I'm going to give everyone an opportunity to get logged in to Conferences.io that need to do that. The first code that you're going to submit is 940. I'm going to present one at the beginning of the presentation, one in the middle, and one at the end. That first code is 940. All right, now that we've covered the housekeeping items, without further delay, I want to introduce Michael Weidokal. Michael's an internationally recognized economic and geopolitical forecaster who helps business leaders, policymakers, and the wider public to understand issues and trends impacting the world today and in the future. He's the president and founder of International Strategic Analysis, a leading provider of economic forecasting, international market intelligence, and geopolitical analysis with clients around the globe. Thank you for being here, Michael. I look forward to your insights. I'll let you take it from here, and you can go ahead and start your presentation when you're ready.
Well, great. I'm ready to go. We've got a lot to get to. We've got an entire world to cover in about 45 or 50 minutes. So, and a lot that's going on in the world. So again, my name is Michael Weidokal. I'm the Executive Director of International Strategic Analysis, and I'm going to be talking about the outlook for the global economy. We are going to be talking about the economy today. So what's going on in the world right now here in 2024, where we've come from over the last couple of years, because obviously we've come from a period of economic uncertainty, political uncertainty. We'll be talking about the near-term outlook for this year and the next couple of years, and then we'll be talking about some long-term economic and risk factors that you need to be aware of. All through the course of this presentation, we're going to be talking about what this means for you, for your company, for your industry, so that you have a better understanding of how these global and domestic issues are going to be impacting your business both now and in the years going forward. So without further ado, we should get started. So we're going to start about talking about where we are right now today in April 2024. We have been bouncing from crisis to crisis in the 21st century, particularly over the last 15 years. If you go back to the financial crisis of the early 2000s, to the various crises that impacted the global economy in the years thereafter, the COVID-19 pandemic, and all of the geopolitical risks that we've been facing in recent years, it has been a period of relative economic and political turmoil. Of course, the impact of the COVID-19 pandemic is still being felt. Some of the factors that emerged from the pandemic are still impacting the economy today. One positive, and we'll be talking about this in the coming minutes, is that consumer spending has prevented a larger economic downturn. The economy has been boosted by robust consumer spending. And at the same time, we're going to be talking about how the era of rapid globalization is coming to an end, transforming into something more akin to a system of regionalization, rising levels of protectionism. So much to get to. Let's start with the global economy. Where are we? This chart shows the rate of economic growth on a global basis over the last 10 years. We can talk about the impact that the COVID-19 pandemic had. We saw that the global economy shrank by almost 3% in 2020. It bounced back strongly, of course, in 2021. And if you look at the last 2 years, it's settled into a relatively healthy rate of growth, certainly a rate of growth that is higher than had been expected not that long ago. We estimate that the global economy expanded by 3.2% last year. That's faster than expected. And a lot of that growth was coming from right here in the United States. The US economy, the leading contributor to this better performance in 2023 than had been expected. The US economy grew by 2.5% last year. This was a much better result than many economists had predicted. There was a survey taken at the beginning of 2023, where over 60% of the US's top ranked economists forecast a recession in 2023. Well, that didn't happen. The US economy performed much better than expected. It's bounced back from the COVID pandemic much stronger than expected. And we'll talk about why that is going forward. But as you can see, if you take away the crises years, you take away the pandemic and the year thereafter, even if you go back to the financial crisis, the US economy has been relatively steady in recent years, growing at about 2.2, 2.3% per year, going back to the financial crisis of 2008 and 2009. If we look at China, a lot of focus on China over this past year. China's recovery was not as strong as had been expected. A lot of people expected a very strong performance by China last year. It grew by 5.2%. Now, in the first quarter, we already have China's first quarter GDP growth numbers from this year. It grew by 5.3%, so a slightly better result. But China's economy clearly is not growing as fast as it had in the past. And there are many threats to the Chinese economy that we're going to talk about as we look at the near-term outlook in a few minutes. But clearly, the growth that China was generating in the past is no longer as robust as it had been. So if we compare the US's performance, let's say over the last 5 years to other developed economies, the US looks quite good. The US economy has grown by 2% per year over the last 5 years. So we're encompassing the period from just before the pandemic through the pandemic to the recovery phase. And you can see the US looks pretty good together with Asia's faster growing developed economies. Where the growth hasn't been is Europe. The European economy has performed very poorly over the last 5 years. In fact, it's performed quite poorly in the 21st century as a whole. But as you can see, whereas the US economy has done quite well, Europe and Japan have not. Japanese economy has shown some signs of life over the past 12 to 18 months, but nevertheless, much faster growth in the US than in its peers around the world. If we look at emerging markets and their performance over the last 5 years, again, it's Asia that's growing faster than most other regions, but it's not growing as fast as it had. The disruptions caused by the pandemic and other factors clearly led to slower growth, not just in Asia, but in all emerging markets. It's been those emerging markets that are more diversified, that have economies that are more diversified, that have been more resistant to the turmoil of the last few years. As a result, economies such as Latin America have struggled mightily. Now, again, Latin American economies have shown some better results over the last 12 to 18 months, but still trailing well behind most other emerging markets. So what are some of the risks facing the US and global economy right now here in the spring of 2024? Clearly, political risk is one. And again, we'll talk about the election coming up. We can't avoid it as we look at the near-term outlook. But nevertheless, internal political risk is a rising threat to our economy, both in the US and around the world. We're seeing rising levels of political extremism on both the political right and the political left. We're seeing increasing political fragmentation, which is making it ever more difficult for governments to enact policies. We've seen that recently in our House of Representatives. We've seen that in Europe, where following elections, where there's a parliamentary system, it's impossible to form new governments. This fragmentation is a real threat to our economy. And of course, we're seeing an increasingly narrow focus of individual segments of our society, focusing on one or two key issues as opposed to looking at the big picture. And this is a very big threat as we face some of the challenges that our world is going to face in the years and decades ahead. Of course, there's a huge amount of geopolitical risk in the world right now. The war in Ukraine is now more than 2 years old. We are expecting a Russian offensive in the coming weeks and months. Whether Ukraine is able to withstand that offensive remains to be seen. Its counteroffensive last year, which we discussed in this presentation 1 year ago, really did not work. Russia's defenses were far too entrenched. The defenses, anyway, on the advantage in the war in Ukraine, particularly with the use of drones to stymie offensive activities. So this is a big time in this war in Ukraine. If Russia's offensive fails, there's going to be a lot of pressure on both sides to come to the negotiating table. If it succeeds, it does remain to be seen how Russia will try to take advantage of the gains that it would make if this offensive does manage to take territory. It's not the only war going on. There's wars going on all over the world. The war in Gaza, of course, continues. The death toll in Gaza is now over 34,000. This followed, of course, Hamas's attack on southern Israel in October 2023, which left over 1,200 people dead, and there are still over 200 hostages that we know being held in Gaza. So this war will continue. It's destabilizing the region. We've seen Iran start to get involved with Israel. They fired 350 drones and missiles at Israel just not long ago. Israel retaliated by striking an air defense base near the Natanz nuclear facility in Isfahan in Iran. So the potential for escalation is also there, though it does look like the two sides in that dispute may try to reduce tensions. And of course, there are tensions in many other parts of the world, the South China Sea, the situation involving China and Taiwan, et cetera. So there is a lot, in short, there's a lot of geopolitical risk in the world today. Some of the economic risks we're looking at, of course, labor shortages persisting in many parts of the world. We've seen unemployment rates start to rise in Europe, where the economy, as you've seen, is not doing quite well. But in other parts of the world, labor shortages remain a significant threat and a significant factor in raising inflation rates. Inflation rates have not fallen as far as expected here in the U.S. In fact, they've risen over the last couple of months. It's up to 3.5%. This is likely to come down slightly in the months ahead, but not significantly. It is falling in Europe. We've seen inflation rates fall significantly in Europe. And most notably, we see deflationary pressures remaining in place in China. China's inflation rate today is just 0.1%. It had been negative for a number of months late last year. It is probably headed for negative territory again in the coming months. And this is something that is reminding a lot of economists to what happened in Japan in the 1990s. And it is a major threat to the Chinese economy going forward. And we'll talk about some of the impact that could have a little bit later. Interest rates remain high, of course. The impact of these higher interest rates has been noticeable in many economies. Where it has not been as noticeable has been in the United States, where the U.S. economy keeps growing at a very rapid clip. It's expected to grow at U.S. economy expected to grow about 2.9% in the first quarter. We'll be getting the first estimate of that later this week. But in other parts of the world, these higher interest rates have been having a noticeable impact on the economy, and we're starting to see central banks beginning to introduce tentative rate cuts in many parts of the world. We expect the Eurozone to do so shortly. Japan, of course, raised interest rates. I should make a note of that. For the first time in a long time, the interest rates had been negative. They raised them by 10 basis points, so now they're 0%. But everywhere else in the world, interest rates significantly higher than they were a couple of years ago. And we'll talk about their direction in a little bit.
Great. Thank you, Michael. I just wanted to interrupt you briefly. The second code for CPE today is number 241. That's number 241. Thank you. You can continue.
Great. Another issue, of course, and this is both an issue for today and a big one for tomorrow, is debt. We've seen debt levels rising for decades. We saw a spike in debt during the pandemic. Um, and of course, and rightly so, a lot of the focus is on public debt. Our public debt in the United States just passed $34 trillion dollars and is rising by another $1 trillion every 100 days. This is being mirrored in many parts of the world. So public debt is a major threat. Um, with interest rates being higher, of course, paying off that debt has become a huge component of public spending in the United States and other parts of the world. But it's not just public debt, it's also private debt. And this is most notable in China. You've seen in the news some of these Chinese real estate developers. Think about Evergrande, think about Country Garden, hundreds of billions of dollars of debt that they're holding and are unable to pay off. So it's public debt is a major long-term threat. We're going to need to see public spending cuts inevitably around the world in the coming years and in the coming decades, but it's also in the private sector a significant risk as well. Of course, there's many opportunities for growth as well right now. We don't just live in a world full of risks and threats to your business. There are many opportunities for growth. Consumer spending has been one. Consumers have been the key driver for growth over the last 2 years, really. You see some of the retail sales growth from last year, with the exception of Europe's large economies. Retail sales growth was relatively robust last year, despite high rates of inflation, despite higher interest rates. Consumer spending has remained relatively robust. And that's been an avenue of growth for many businesses over the last couple of years. Another factor, and this is most notable here in the United States, is that certain sectors of the economy are really driving growth. If you look at that chart on the left, it's quite interesting. It shows which sectors in the United States have been growing over the last 5 years. And this is their average rate of growth per sector over the last 5 years. And it's no surprise who's there. The information sector really being a key driver of growth, professional services growing by almost 6% per year, and then the recovery of the arts and leisure sector after the pandemic has been significant. So you can see where the growth is coming from. Now, some of these sectors were impacted, let's say, at a greater level by the pandemic than others, but nevertheless, it paints a very clear picture. And if you look at different countries and their reliance upon certain sectors of the economy, it really does mirror their economic performance. Those economies that have a strong position in these high growth sectors are doing better than those that are dependent upon lower growth sectors. So that's certainly something to consider. Of course, new technologies emerging. This is a major issue, which we will touch upon again in this presentation. The public awareness of generative AI. Obviously, it's been in use for some time, but it really came to the fore early last year. Um, is transforming many sectors of the economy, many businesses, many jobs. And it's not just AI. There are many other sectors which we'll talk about going forward as well. But this is real. We are really in a period of technological transformation that is both providing risks, but also major opportunities for businesses to grow in the future. So how does a business succeed in April 2024? Well, obviously, businesses need to identify the immediate threats to their business. Understanding those threats and identifying them is the first step in being able to avoid them. At the same time, businesses need to reduce their exposure to high risk, low growth segments of the market. Those businesses that are focusing on growth segments that have the potential to grow in the coming years, are more likely to do well. Why is the US economy outperforming many of its other rich world peers? Because it has a very strong position in high growth segments of the economy. This holds true for businesses as well. So how do you take advantage of the opportunities today? Well, you identify the right opportunities for immediate growth and you focus resources on those growth markets. It's one thing to do a number of studies on them and to talk about them, but it's actually focusing resources on those segments of the economy that provide opportunities for growth. So that's where we are today. What I want to talk about now is where we're going. And we're going to talk about first where we're going both this year and over the next couple of years. So the near term outlook. And by near term, I mean really from now until the end of 2026. So just over 2.5 years. If we look at the near-term outlook, we still see the US outperforming other major economies, particularly other wealthy economies. The outlook for the US economy has improved significantly of late. We'll talk about some of the reasons why going forward. We expect the global economy to grow a little bit below pre-pandemic levels. And this is a long-term trend that's been continuing for some time. So we'll talk about those growth rates as we go forward. And then many of those factors we just talked about, they're still going to be in place both this year and over the next few years. So there's our forecast for the global economy. As we talked about, we expect the global economy, its final growth rate to come in at 3.2% for 2023. We're predicting 3% in 2024. That's a significant increase to where we were a few months ago. I think we are at 2.7 or 2.8% at the beginning of the year. So the outlook has brightened. We do expect growth to slowly trend downwards over the next couple of years, so a little bit below 3%. And keep in mind, between the global financial crisis and the pandemic, global economy was growing at about 3.5% per year. So we are growing at a slower pace, and it may not sound like a lot, but it's 20% slower than where we were just a decade ago. And there's a number of reasons for this trend, which we'll talk about going forward. As far as the US economy, we're forecasting growth of 2.4% this year. Some economists are a little below us, some are a little above us, but no, I think that's pretty close to the average right now. So we're at about 2.4% with our growth forecast. We expect growth to be a little stronger in the first half of the year and then slow some in the next half of the year, and then to slow again in 2025 before picking up in 2026. Now, there are a number of variables which could impact the US economy going forward, the election obviously being one, uh, some other factors, including persistent inflation, what the Fed decides to do with interest rates, which we'll talk about going forward. But we do have that's a relatively optimistic outlook for the US economy over the near term. If we look at China, we're forecasting China to slow. China's economy, as I mentioned, grew by 5.3% in the first quarter, a little bit better than expected. But we do expect the Chinese economy to be growing by less than 4% per year within the next couple of years. And there is a real risk of a harder landing for the Chinese economy in the coming years. The debt crisis in China, particularly in its real estate sector, but also in many of its other infrastructure sectors, is real, is really harming consumer spending in China. And what we're seeing China react, how we see China react, and this is to be expected, is they're really starting to promote exports. They're really going to take steps to promote manufactured exports in the coming years, providing a lot of competition for local manufacturers because the domestic market in China is weak and is not likely to strengthen significantly in the coming years. So in order for China to continue to grow, it's going to have to grow through exports, something it was trying to avoid. China was trying, of course, to rebalance its economy to a more consumer focused or consumer centric economy. It does not look like it's going to be able to do that in the coming years. So expect very strong Chinese competition in the manufacturing sector as China tries to export its way to growth in the coming years. These are our average annual GDP growth forecast for the next 3 years. You can see the US coming in on top, 2.1% growth per year over the next 3 years. Compare that to Europe, which is a little bit below 1%, Japan at 0.4%. You can see the US again looking very favorable. And why is that? Because the US has a very strong position in high growth sectors of the economy. The US has a very strong position in energy, which is a big factor right now. The US consumer market remains relatively strong compared to its peers. And so the US economy has a very favorable outlook when you compare it to other wealthy countries around the world. As far as emerging markets are concerned, again, Asia will remain the driver of growth, particularly Southeast Asia and India. We're expecting growth of more than 6% per year in some of the larger Southeast Asian emerging markets and in India. The Indian economy growing at a little more than 8% right now, which is probably a little higher than it's able to maintain, but nevertheless, a pretty strong outlook for growth in that region. And a lot of that is coming from manufacturing. A lot of manufacturing investment that used to go to China, of course, is now going to Southeast Asia and going to India. And so they not only do they have uh, fast growing domestic markets, but they have fast growing manufacturing sectors as well. Other regions not expected to grow as rapidly. Latin America forecast to grow at about 2% per year, which is somewhat disappointing. Mexico at about 2%. Mexico, also a country that's starting to attract more manufacturing investment as, let's say, friendshoring becomes a bigger trend. But as you saw in that chart earlier, Mexico is really impacted by labor shortages. Its unemployment rate is well below 3%, and in northern Mexico as low as 2% in some of the more dynamic regions of that part of Mexico. So again, in emerging markets, growth primarily coming from Asia. So what are some of the near-term risks to the U.S. and global economy? Well, we have the elephant in the room, the election coming up in November, and this is going to be a close-run election and a contentious election. And there's a lot of potential disruptions that could be caused. We could have defenestration, where one of the candidates is removed. We could have incapacitation because the combined ages of the two candidates will be 160 at the time of the election. We could have incarceration. There's so many potential variables to this election in the coming months. If you look at that chart there, those are the seven, and it really is only seven states that are going to decide this election coming up. Those are the recent averages of polls. Of course, Donald Trump has been in the lead for some time. His lead has shrunk in recent weeks. The key state looks like it's going to be Michigan. If we just look forward to November and let's say Donald Trump wins Georgia, Arizona, North Carolina, and Nevada, where he holds larger leads, and let's say President Biden wins Wisconsin and Pennsylvania, where it's very close, it's going to come down to Michigan. And Michigan could be that deciding swing state. We've had scenarios like this in 2000 and 2016, where really one state has a very knife edge result. It well could be Michigan. And of course, we've seen in Michigan a backlash against President Biden from the Arab American community there over his policy towards the war in Gaza. That could well damage his chances of winning what might end up being the decisive state. But there's a long way to go, obviously, before the election. We're a little less than 200 days away from the election, but it is going to be a decisive and divisive election, and it could have major economic impacts going forward. Should the election remain close, should the level of contentiousness rise, businesses could start to hold off on investments. Foreign companies could hold off on investing in the US should the political situation look increasingly volatile. So there's a lot to watch here. There's a lot of things that could change in the months ahead. And we're not the only ones holding elections this year. The countries with more than 4 billion people living in them are going to the polls. Some of these elections have already taken place. In fact, all of those elections up to India on that chart on the left have already taken place. But we've still got some major elections coming forward. An election in Mexico, we've got European Parliament elections. India's election just kicked off this week. It's a massive election. There's 970 million eligible voters in India. The results will only be announced on, I believe it's June 4th. So we've got some time before we get the results. One of the interesting things about the election this year, of course, the U.S. election is very close and is going to go down to the wire. Almost all of these other elections have been very one-sided. We expect the Indian election to be one-sided. We expect the Mexican presidential election to be very clear with Claudia Sheinbaum winning. We expect Prime Minister Narendra Modi to be reelected, his BJP party to be reelected in India. So most of these elections, the polls are very clear. It's the U.S. election where it's going to come down to the wire. Of course, many geopolitical flashpoints, which we talked about, are going to remain in place. A big focus needs to be on what's happening in East Asia, particularly revolving China and Taiwan and in the South China Sea. But there are many other flashpoints that could play a significant role. And if we start to see conflict risk rise on top of the internal political risk rise, that will inevitably have an impact on the economy, as it will dampen business and consumer and investor confidence to the detriment of the economy. Labor shortages will persist. We expect labor shortages to remain in place. Working age populations are shrinking in Asia and Europe. We've talked about in the past, about some of the demographic trends, the falling birth rate, the level of immigration starting to fall. So we're starting to see labor shortages becoming a big problem, becoming a bigger problem in the coming years. Now, automation will offset some of those labor shortages, and AI may boost productivity to help offset some labor shortages, but they are still going to remain a significant factor in the coming years. Productivity growth. Now, we haven't talked about that yet, but if you've heard me in the past, productivity growth is the key to economic growth. We've started to get some positive news finally. Productivity growth has been declining in the rich world since the 1970s. The numbers in productivity growth have been terrible in recent years. We've started to see a little bit of an improvement, particularly in the United States. Now, is this just a temporary blip or is this a long-term trend? It remains to be seen. Productivity numbers are very hard to interpret and they take a long time to interpret, but maybe, just maybe, we're starting to see some positive signs on that front. Debt, we talked about debt going is just such a big issue going forward. Uh, Keep this in mind. By the year 2050, the US will be paying more on interest payments for its debt than it will be on combined education, highways, and defense by the year 2050. That's a staggering number. And that's a trend that's happening all around the world. And it's not just happening in the public sector, it's also happening in the private sector. We haven't touched upon climate yet, but clearly we are experiencing what is yet again a record-breaking year for temperatures around the world. We broke many temperature records last year. We're breaking them this year. I'm sitting here in Northeast Ohio. I grew up here originally. I've been back here for a couple of years. Um, I remember, I remember our winters being cold and snowy. We just came off the warmest winter in our history. I think I was out running in shorts and a t-shirt at least 10 or 12 times in January and February this year. We are clearly in a world that's getting warmer. The impact of that is going to be felt on all sectors of the economy going forward. It is a slow, long process, but it is nevertheless a trend that is unmistakably happening. And those businesses that are able to prepare for that have a better chance of long-term future success than those that don't. What are some of the opportunities? We are expecting inflation finally to ease slowly but surely. These are our interest rate forecasts for this year, so the average rate. As you can see, they are still relatively high, still above the 2% target that many central banks use as their inflation target, but they are slowly forecast to come down, also here in the US. But we may have to wait a few months. Inflation could remain above 3% here in the US for at least a couple more months and then fall in the latter part of the year. Now, the thing we're watching closely will be commodity prices, particularly when you link it with geopolitical risk. So far, oil prices did not react much to the little tit for tat between Iran and Israel, but should we see Ukraine continue to target Russian oil and gas facilities, should we see Houthi rebels go after oil shipments going through the Red Sea or in the Gulf of Aden, should we see a conflict involving Israel and Iran that's much larger than what we've seen of late, then we could see a sharp increase in oil prices and other commodity prices. And that would then force us to reassess our outlook for inflation going forward. Interest rates will fall eventually. Our initial forecast for interest rates in the United States was 3 25 basis point cuts. We have now we're about to reduce that to 2, and it's going to be we expect them to be delayed. There have been some reports of concern about interest rate hikes. We've seen nobody in the Fed is talking about that yet. I don't think there's any desire to enact a 25 basis point rate hike in the coming months. Now, should inflation surprise on the upside, should the job market remain incredibly strong, should the economy grow faster than expected, you can't rule one out. But as far as we look at our forecast now, we do not expect any interest rate hikes. We expect 2 25 basis point cuts, which would put us at 5% now in the latter part of this year. So we do expect interest rate cuts in the US to be delayed. We do expect them to be enacted in Europe and in Great Britain and in some other parts of the world because their economies are significantly weaker and because their inflation rates have come down somewhat. But in the United States, it's going to take a little bit longer. Now, this is going to lead to a strengthening of the dollar. Obviously, the dollar is quite strong as it is. But if the US holds off on interest rate cuts longer than expected, and if other major economies enact interest rate cuts as expected, the dollar is going to strengthen even further, which will, of course, pose a challenge for exporters from the the United States. We expect the trends of reshoring, nearshoring, localization, friendshoring to continue. We've seen a major surge in foreign investment in the United States in recent years. We've seen a similar thing happening now in Mexico. Um, in contrast, foreign investment in China declined last year, and the early foreign investment numbers from China this year are not good. So foreign investment clearly is moving. It's moving back to the United States. It's moving to Mexico. It's moving to some other Southeast Asian emerging markets. The big issue here in the United States is that we still face some significant constraints in terms of labor shortages, in terms of infrastructure, which could limit our ability to grow through reshoring. Now, there's a definite desire for companies outside of the US to invest and for US companies to invest again in the US, but some of these factors that we've been talking about, particularly labor shortages, could hamper our ability to attract as much investment as possible. We're hoping that productivity growth is going to continue on the positive side. We've seen some interesting numbers in recent months. We hope that continues. It does remain to be seen. Other parts of the world have not seen those increases in productivity growth rates thus far. Of course, a ton of technologies out there that we're keeping our eye on, artificial intelligence, 3D printing, et cetera. So many different technologies. We are truly in the midst of a period of technological change and breakthrough. And those companies that are on top of these technological changes are the ones that are going to succeed. Keeping abreast of technological change is absolutely imperative for companies in 2024 and beyond. So how do you succeed in the world of the next 3 years? Well, you need to understand these technological changes and how they're going to transform your economy, your industry, your business. You need to identify the near-term risks to your business. Do they match the risks that exist now, or will they change over the next few years? And then you need to protect your business from sudden changes in the economy, in politics, in the marketplace. How do you take advantage of the opportunities over the near term? Well, you identify those markets that are going to provide the best opportunities for growth. It could be a certain segment of the market, it could be a certain country, but identifying the true growth markets is absolutely imperative. And then investing resources, capital, personnel in high growth markets and in high growth industries is absolutely imperative. And I accumulate the resources you need to grow when these opportunities arise. Many companies are very good at being able to cut resources when things go bad, but many companies are bad at having the resources in place to take advantage of new opportunities when they arise.
We have the final code number 3. It is 758. Code for CPE is 758. Thank you.
Okay. So now finally, we're going to get into the long-term outlook. This is what we're really talking about here, the next 20 years. Generating economic growth will become more challenging over the long term. This is primarily due to the fact that demographic decline is accelerating in nearly all major economies, while environmental risk is also going to be a major factor. We haven't touched upon demographic decline too much, but the world's population growth is slowing at a pace that few demographers would have imagined just a decade or two ago. This means the marketplace, the growth in the marketplace is shrinking. The amount of potential workers, the amount of potential consumers is in decline and is going to continue to decline in the years ahead. The era of globalization appears to be over. We are living in a much more multipolar world with higher levels of regionalization, higher levels of economic and political tension. And the key to the economy over the next 20 years to offset some of these factors is going to be technology and productivity. Can we achieve breakthroughs in technology that lead to productivity growth that allow our economy to continue to grow over the longer term in the face of this demographic decline, in the face of these environmental challenges, and in the face of this increasingly divided world? Well, these are our long-term economic growth forecasts. This is average economic growth by decade. What's interesting to note there, and this is the global economy here, you can see how growth slowed in the 80s through 2010s, averaging about 3% per year. We're looking at growth now at about 2.5% per year over the next 20 to 30 years. So it's slower. Again, it's not a huge decline from if you go from 3% to 2.5%, But still, the fact that the world will be growing about 17% slower than it did in the previous decades is still a significant challenge for many businesses. And some of this slowdown, much of this slowdown, is coming in those markets that drove economic growth in previous decades. We look at our US forecast, we're forecasting growth of about 2% per year in the 2020s to slow to 1.8 and then 1.6 in the 2030s and 2040s, respectively. Again, this will look favorable when compared to other major economies, but it is nevertheless a major challenge. Imagine, growth used to be well above 4% a couple generations ago. It then hovered around 3% in the last generations of the 20th century. It's hovered around 2% so far in the 21st century and is forecast to slow a little bit further going ahead. The only way this slowdown will be offset is through significant increases in productivity. Again, if you look at the US's performance, or at least its forecast performance relative to other major economies, it is still looking quite good. Uh, Europe forecast to grow well below 1% per year, Japan just 0.3%. So all of the world's developed economies are looking at slower growth over the long term. And this is going to place tremendous strains on public finance. When you combine this slower economic growth with those rising levels of public sector debt, you can imagine what that means for public spending going forward. There is going to have to be at some point a major rationalization, a major decline in public spending under the current system. There's no way this could possibly continue. Some countries have already experienced this with major public spending cuts. Others will experience this in the coming years. As far as emerging markets are concerned, again, Asia will continue to be the leading provider of growth, but you see China significantly slower growth. We're looking at China growing at just 3% per year over the next 20 years, a far cry from the 10% growth China achieved not that long ago. Other emerging markets, Latin America growing about 2% per year, East Europe a little bit less than that. Africa, which we haven't touched upon, but Africa, of course, its population is going to grow by 1 billion people between now and the year 2050. We're looking at growth of about 3% per year. So again, a definite slowdown um, for the global economy coming forward. The only way this can truly be offset is through tremendous breakthroughs in productivity, and it is possible. I'm not discounting that that is not a possibility. This is just a reminder. You've seen this slide before. The blue line is economic growth in developed economies, the red line in emerging economies. We have been growing so far in the 21st century largely because emerging economies, particularly in Asia, were able to offset the declines we saw in Europe and Japan in particular. Those economies are not going to grow as fast as they did in the past, and as a result, we're going to see lower rates of economic growth over the long term. What are some of the long-term risks to our economy and to both here in our economy and the global economy? Well, political risk isn't going away. Um, our faith in institutions here in the US has fallen dramatically in recent years. We used to have a very high opinion of our political institutions in this country. No longer. That is a significant risk. We expect polarization and fragmentation to continue. We expect authoritarian regimes in many parts of the world to be further entrenched and not lesser entrenched. The spread of democracy really does not appear likely to continue. In fact, we do expect somewhat of a rollback in that area. And then, of course, geopolitical flashpoints will remain. And it's not just the current ones. We're expecting many, many major potential risks in the coming years. The relationship between the US and China is the most important. How China goes about its relationship with Taiwan, with its neighbors in the South China Sea, with India, where it has major disputes, and of course with the United States, will determine the level of security in the world in the coming years. But there are many other issues as well. We expect stressed resources to drive population exoduses from some parts of the world. We expect parts of the world that are currently relatively destabilized to remain so. So geopolitical risk is going to remain a huge factor on the impacting the economy in the coming years. Demographic change is going to continue. The change in the under 18 population over the next 20 years, which you can see there in the chart on the left, is going to be dramatic. Every major economy will see a decline in their youth population. We're seeing this already impacting the labor market. We're seeing this impacting The university sector, for example, we're seeing universities running into a lot of trouble as their potential market declines. And those businesses that are focused on younger consumers face a real challenge as their market shrinks dramatically. This is also happening with the working age population, so the population between the ages of 18 and 65. It is going to continue to grow in some economies, including the United States. Interestingly, our working age population will grow by about 5% over the next 20 years. Now, this is much slower growth than in previous decades. And in other parts of the world, it's going to decline significantly. China is going to lose 13% of its working age population. Japan is going to lose 21%. Japan's already been losing its working age population, but you can see some major declines there. Now, again, on the supply side, this can be partially offset by automation. But on the demand side, those robots aren't buying Big Macs, they're not buying shoes. It is going to prove to be a significant challenge for the global economy. And it's happening because people are having less and less babies. The birth rate around the world is falling. A country needs to have, the average woman in a country needs to have 2.1% for that country, 2.1 babies in her lifetime for that country not to lose population. That's assuming no immigration, no immigration. The birth rate in the United States has fallen below 1.7%. The birth rate in South Korea last year fell below 0.7. So people are not having babies anymore. No policies that governments have enacted have been able to reverse that. And that's why we are in this demographic situation we are today. Of course, we live in an increasingly regionalized economy. That's not going to change. This trend towards reshoring and friendshoring is going to continue. Long-term debt is just going to grow dramatically and is going to put great strains on public finances. Some of this will be in the form of interest payments. A lot of this will be in the form of payments for elderly populations, which are growing as a share of the population. And this is going to prove quite unsustainable without a higher degree of economic growth. The climate, of course, we've touched upon the climate. The world is expected to get warmer, and storms and other natural disasters, climate-related natural disasters, are expected to worsen and impact more heavily populated areas of the world in the coming years. As far as opportunities are concerned, well, there's a number of opportunities for growth over the long term, and many of them center around new technologies and new processes, particularly those that are able to offset these worsening labor shortages and drive higher rates of productivity growth. They also, we're going to have a big impact, of course, on socially. We will talk about the election and how is AI and social media going to impact this election. We've been watching it closely in places like India and places that are in the midst of elections now, and it is quite worrying. On the other hand, health-related technology could extend the productive lives of the world's population. The idea that everybody retires in their lower to mid 60s may change. At least certainly in some fields, it could change. Japan has been trying to do this already because of their demographic situation. New sectors of the economy are undoubtedly going to emerge. 60% of the jobs in the United States that exist today did not exist in the year 1940. So undoubtedly, new sectors of the economy are going to emerge. And look, we've seen, where is our growth coming from? A lot of it is coming from sectors of the economy that did not exist that long ago. New markets are emerging, particularly new emerging markets. Population growth, while it's shrinking in many of the world's leading economies, is growing rapidly, as you can see in that chart there on the left. And then, of course, if your market is the over 65 population, your market's growing. Look at how fast the over 65 population is going to grow in the world's leading economies over the next 20 years. So if you're not focused on those consumers, and those consumers often have a good deal of money, you should be, because this is where a lot of growth is going to come from. For people over the age of 65, their specific needs and wants will have to be met by businesses going forward. Now, of course, it's a risk to government finance if this segment of this population does not become more productive, but it has a huge untapped potential going forward. So how do you succeed in the world of the next 20 years? Well, you need to stay ahead of upcoming technological and process changes. If you do not have people on board who understand AI and understand some of these new technologies, you need to get them on board as quickly as possible. You need to diversify your business to avoid overexposure to sectors that are going to decline over the long term. And you need to educate yourself on the upcoming changes to the world and to the economy. And that's what you're doing here today, for example. It's understanding these long-term, near-term and long-term changes that are going to impact your business. How do you take advantage of long-term opportunities? Well, you identify the best opportunities for long-term growth, which segments of the economy are going to provide us with the best opportunities to grow. You prepare your business to take advantage of the growth opportunities down the road, and you accumulate the knowledge and resources that your business is going to need to grow over the long term. So that's all from me. I think I pretty much kept us in time. If anyone has any other questions that you don't think of now, this is how you can get in touch with me. I would be happy to take any questions. But if anyone has any questions right now, I'm happy to take them.